Good morning to everyone. I hope you're all fine and, like always, ready to take a course of today. I welcome you all to yet another session of SBR. In the middle of the discussion of step acquisitions, we have left the course the last week and will continue the course today from exactly the spot we have left the course the last week. Now, you people have already started learning the complex aspects of consolidation, and I hope you always keep the guidelines that I give it to you coming into a course by revising, which makes the life of yours easier to start the next course. Within the live session, you enjoy it must when you come into a course by revising, because this will make you gain a momentum, the flow that we are in, and easily we always can start. Let's connect ourselves to the board to see what was done the last week so that we can continue exactly from the place we have left the course the last week. Chapter number 2. Exactly, this chapter had two sections. A section of step acquisitions and a section of disposals of subsidiaries. This was that section we have finished the last week itself, and we will be able to finish this one today. And this chapter expects to take 2 sessions. The first session on that we have had it the last week. The second one we will have it today, and this chapter will be finished. All what we have done, being the part of step acquisitions, the knowledge, the technicalities, all those summarized points and applications. The disposals of subsidiaries are going to be pretty much the same, but will exactly be the opposite of that. So easy to understand that opposite when you know the original topic first. If I try to show to all of you the board explanation of the last week, we started off by defining what is step acquisitions, the number of cases that this topic has to offer, the definitions of these cases, and then each case was looked upon in detail. That how the way the whole notes making, you people have seen the bullet points, and I was not just reading those bullet points, I was rather giving the whole logical reasoning behind why not to consolidate, or if to consolidate, do we have to consolidate normally, differently, goodwill if we have worked originally requires to have any adjustment later on or not, if not, why not, and then ends everything that was being looked upon. It was not just I had been able to read that. No, I have rather been able to give you all with the proper explanation of that. Why is it like this and why is it not like this? Separately for statement of financial position and statement of profit and loss. And then the whole knowledge after getting each case, we had applied it into the number of questions. As you can see, this was one of the question we have done, illustrative example 2.4. I can see learning example 2.4, another one after to it. So after making sure that adequately we have devised ourselves with that case, we jumped ourselves onto the next one, associate to subsidiary. And same like for statement of financial position separately, statement of profit loss separately, and followed by its required questions. Then came the third one, same way, statement of financial position separately, statement of profit loss separately, and followed by their respective questions. This has taken the whole 3 hours of last week because I was being so much impatient in explaining each case. And roughly, you can say each case has taken about 45 to 50 minutes of explanation. Now we are formally making a start of the course of today by landing ourselves onto the disposal aspects. So the title page of step acquisition, if you go and look back on once again, and the title page of the disposals, you look down onto it for the first time, you will exactly see the way the number of cases being defined in the first. Full disposal, part disposal. Within the part disposal, we can see further 2 legs, retention of control, losing the control. Within the losing of control, we see further 2 cases down below. So on the first page, the number of cases have at least been defined. Number 1, 2, 3, and 4. There are 4 cases. And the way that each case will be talked about is exactly the same way the last week we have talked about, by taking the one case and working it out onto the side of statement of financial position and statement of profit and loss. Let's go and have a look onto the title page for about a minute. Full disposal is when the subsidiary is entirely disposed. 80% is what they had a hold, and they have disposed the entire 80% interest. That's called as full disposal. Whereas part disposal is the one within which they have disposed a part of it. With the disposal of subsidiary in a part can happen, they might have lost an interest, or they may have still retained. Examples down below, they are clearly explaining they had an interest of 90%. By disposing a part of it, they're still controlling more than 50. By disposing a part, the control is gone. It was held like a subsidiary, but now will be held like an associate. Control gone, lost. A part disposal. Same way, a disposal of part will get them to lose a control. Had been controlling it by 80%, will no longer be. Becomes what? A simple investment. So these cases are exactly the opposites of what we have done the last week, because the last week we were taking a step of acquisition. So by taking a step, the control was rather gained. It was an associate. By taking a second step of investment, it turns out to be a subsidiary. Control. It was a simple investment. By taking a second step of investment, it turned out to be a subsidiary. Whatever is happening right now is exactly the opposite of that. Originally, these companies are subsidiaries, and by disposing a part, transforming to become an associate or simple investment. It was a subsidiary by disposing a part, although still a subsidiary, but by a little less control now. So a lot of explanations this way will come to you, where you will feel it like, yeah, we are sort of having the same debate we have had it the last week, but yeah, everything will be in opposite way. So let's go and take the first one, try to talk about into depth. Let's start off with the first one, the one that I can find it to be a little odd one. See, these 3 cases are same for one reason: loss of control. Obviously, full disposal is a loss of control. I did not need to write that. It's pretty obvious when a subsidiary is disposed entirely, there's going to be a loss of control. And these 2 are also the cases of loss of control. That will make these 3 cases to be the same. And this one is the odd one out. So we can try to work this first and get away from, and then we can focus on these 3 in a one go. So let's take a page out where the case is explained, and that page is this one. Let's define this case on the first. Subsidiary it was, remained to be a subsidiary. How come? They had been holding this company by 90%, and after disposing a part, turned out to be a subsidiary, but now by a little bit of less control. It was 90% controlled in a picture before. Now will be 70% controlled in a picture after. And there is a disposal of an interest, part of an interest. So what will be the effect of that on the consolidation? Every topic we've done the last week, see the title page of that topic was clearly visible to all of you. See, it was like this, step acquisition. So that when you will get the copy of this board work, you will never be confused, as every page very formally starts off by writing that, okay, we are working on to step acquisition at the moment. And this is one of the case of that step acquisition topic. The definition of that case with example itself gives you a quick knowledge of that what this case is about. Now, when people have seen me starting working on two disposals today, the title of that page says disposals. And then the same way of writing the title of that case, followed by an example which gives us an instant knowledge of, okay, what this case is about, followed by all of those explanations in a bullet form. So what will be the effect of that on consolidation? They had been holding this company by 90%, still holding, but by 70%. What matters to us at the end of the day, that they're still controlling. So that will make me to do what? Consolidate normally. Because we never have made a difference to any step of consolidation by considering what percentage of interest they have. As long as it's more than 50%, 70%, 75, 80, 85, we just come to exercise the consolidation normally. That's the reason of. So consolidate normally. And you know that normal way of consolidation. Assets in the first place, we come to combine. Liabilities in the second place. Third step, fourth step. We know all the steps now based on to the revisions we have had it in the first two sessions of SBR. You know that normal way of consolidation. So it will not make any difference. You have been holding that company by 90%, now have started holding it by 70%. It makes no difference to consolidation. Same, I will have to come and write it for profit and loss. No difference. It will make to the steps of consolidation. And you have to have an answer to that one. The answer to that is very simple. As long as the P holds the S by more than 50%, one has to consolidate normally. This is the day when the company was acquired actually. This is the day the company was acquired actually. And this was the day the goodwill had been worked actually. Goodwill is worked the time the company is acquired. So this was the day the company was acquired, and they must have worked the goodwill by using that way of cost of investment plus NCI minus the value of net assets. So will this disposal be making an effect onto goodwill? No. Goodwill remains at its historic cost, does not remeasure. So even if they have disposed a part of an interest, that will make no effect to the value of goodwill. It was once worked, later will not remeasure. So you will be least bothered to touch the goodwill with that disposal of 20% interest. Work it out on that day standing and later does not change it, as if no disposal has even been made after. That is the next point I can finally reveal onto a screen. Goodwill originally calculated means at that point of mark remains unchanged. So what is the way of computing the goodwill? Normally, by using full method or partial method, cost of investment, non-controlling interest, fair value of NCI, you know all of that. Once it was worked, there will not change. Because goodwill is that kind of component that remains at its historic value. Does not reemerge. The only one thing that affects the goodwill is the impairment, which changes the value of the goodwill down to impaired value. Otherwise, the goodwill remains always at its historic cost. NCI. Now, if I have to recognize an NCI in this situation, I will have to see the NCI that I find it at the end of the year, which is 30%. So I must have to make sure to recognize the NCI based on the percentage of interest after disposal, which in this case is 30%. That should be the next point, because we must have to see the reporting day picture. Now the reporting day picture suggests P holds the company S by 70. So NCA must have been holding it by 30%. So NCA is recognized based on to the percentage at the year end after disposal. Okay with that? While for profit and loss, what if it was a mid-year part disposal? The disposal transaction has taken place during the year. And mid-year, it can be any day, 4th month, 8th month, 9th month, 3rd month, not necessarily exactly to be the first 6 months. Mid-year acquisition is any case within which the company has acquired the other one during the year. So NCA is recognized based on the percentage both before and after the disposal. Clearly, the reference has been made towards mid-year disposal. So I can expand my explanation towards this point by making one example. If I suppose the year starts on 1st of January 2022, ends on 31st of December 2022. This company was being held by 90%, drops down to 70. And I suppose on 31st of August 2022, there has been a 20% disposal. So how many months we see before and how many months we see after? It's going to be Jan, Feb, March, April, May, June, July, August. There are 8 months. And then we have 4 months. In the first 8 months, P has been holding this company by 90%. So if I go and work the NCI should be by 10%, whereas the NCA now has turned out to be 30. So because of that mid-year disposal, must have to respect the months those are before and the months those are after. So in this hypothetical example, 8 months in the picture before, 4 months in the picture after. So in those 8 months, the NCA is 10%. In those last 4 months, the NCA is 30. So we need to prorate this when there is a mid-year disposal. And that's how the way the NCI is worked in the bottom of profit and loss, if you all can remember. The group, we know that it's always a balancing figure. So when I will go and take the profit after tax of subsidiary, come to multiply it with the percentage of NCI, which in this case is 10%. But this 10% does not stay for the whole 12 months. It stays out only for 8 months. So I will be able to multiply this by 8 divided by 12 to get me that. And then we will use that fraction once again, profit after tax of subsidiary. The percentage of interest will be 40%. And that stays, 30%, and that stays out for the remaining 4 months. See, this is the picture before, and this is the picture after. In the picture before, the NCA had been like only 10% for 8 odd months. And in the picture after, it's been like 30 for the remaining odd months, 4 months. Now, these are the basics of consolidation, that working the NCI out of profit is the basic knowledge that you are keeping it now from the first few courses of SBR, that NCI is worked out of the profit after tax of subsidiary. But when the disposal is involved, especially a case within which a disposal transaction has taken place at some point of time during the year, then we must have to respect the months before and the months after, and then we come to apply it. That for 8 odd months, it was by 10%, then for the remaining 4 months, it was by 30%. This is a true representation of what was written. NCA is recognized based on to the percentage that is before and after the disposal, and we have exactly done it. A picture before, a picture after. Okay with that? Almost a same kind of a case we have done when we were in discussion of step acquisition the last week, and I can bring that out in front so that you people can see how much similar this one is. So while we were discussing step acquisition, this was one of the example I had put forward, where we was holding the company by 60% originally, and by taking a second step of investment, they had started controlling it by 90. And because the step was taken mid-year, so we had been able to find the months those were before and those months those were after. So in the picture before, the NCA was only by 40%. And in the picture after, the NCA was by 10%. So when we came to apply that formula, exactly same way I'm trying to explain it to you today so that you can understand that out with that sort of consistency, uniformity. You exactly can see me preparing another performer of the same kind in today's explanation. But it's exactly the opposite. Because in the case of step acquisition, in the picture before, the NCR will be heavier. And in the picture after, the NCR will be less heavier. Since before taking a step, the hold of NCR was more. And after taking a step, the hold of NCR turns out to be 10. But now when you see into a case of today's explanation, as a result of disposal transaction, yeah. In the before case, the NCR is less heavier, which in contrast to the picture after, it becomes more heavier. So it's exactly the opposite of that. But overall, the theme remains to be the same. That if you have acquired the subsidiary by taking a step midway, or if you have disposed a subsidiary midway, then we must have to allocate the profit of that year into parts, and a picture that is before and after respectively make the use of to get your answers done. That theme remains to be the same, just the opposites, in a way that in the case of step acquisition, the percentage of NCR in the picture before is always bigger. Whereas in the case of disposal, the picture before shows the NCR is lesser, which turns out to be more in the picture after disposal. Yeah, if the step or a disposal transaction takes place at the start of the year, then the whole of that year will be worked based on the picture that is after. So mid-year makes the case a bit more computative. You must have to respect the date of acquisition or the date of disposal for this thing to apply adequately. Enough of that explanation. Then comes this equity adjustment. Now, before disposal of what percentage of interest in my example, it's 20%. Before 20% disposal, and after 20% disposal, the group has been holding it by, in the picture before, 90%, and an NCS interest was by 10%. In the picture after, the situation turns out to be this one. So what actually is happening? It's the group this time who will be making a transfer of part of its interest towards NCS, since they're disposing. This time they are surrendering, they're disposing. Suppose they're disposing the one part and transferring it to another owner, or it's as if you're sharing a part of your meal to someone. So you will surrender that part, not will claim that part. So the flow of transfer is not from NCI towards group, it's from the group towards NCI. And it's exactly the opposite of step acquisition. When step acquisition, the group rather claims extra interest from NCI by acquiring. This time, it's the group who rather surrenders. So again, overall theme remains to be the same, just the opposite way the transfer is happening. So what actually is transferred? This time, equity is transferred. Shares are transferred. They have been holding 90% of an interest. Now they will be owning 70, since they have been able to transfer 20% of an interest or 20% of an equity towards NCR. And to reflect this transfer of equity, an adjustment is passed which is called as equity adjustment. The transfer has been made in between the two of the owners. So to reflect that transfer, one has to pass an adjustment directly into equity. So it's called as equity adjustment. And certainly you people have seen me explaining to all of you this equity adjustment thing the last week also. So I'm again and again trying to remind you of overall theme has not changed. It's just the opposite way the transfer is happening. That will not change the way the whole discussion we have had it last week. So this time the group sells part of an interest. So upon that sale, the group will rather receive a consideration, will not pay a consideration. Payment of consideration is when they are acquiring another step. They are rather disposing today. So they will not pay a consideration, they will rather receive a consideration. So the word received has been used instead of payment. The same topic when was in discussion the last week, I can exactly take that performer out and show to all of you that point of mark, it was like the payment of consideration. See this working for the equity adjustment. Yeah, see in the last course we have had the same talk about transfer, but there it was a payment of consideration which today has been replaced it with the receipt of consideration. See, the flow of transfer was from NCR towards group, which now has been changed to group to NCR. And this is the benefit again to those they come into a course by the revision of last week explanation, because still I'm doing my best to try and connect yourself to the last week explanation. But if you at your side are even revised, then you're making your life by yourself easier to learn these topics. And you're making your life difficult to learn these topics by but not revising. See what type of student are you? And ultimately, you will make the mess of this whole thing by yourself by not listening to the guidelines that I offer each time, requests that I make each time, just by being a little careless, casual, lazy on your studies, and always having excuse of being busy with this and that. The truth is that we do not want to devote our time to this part of our life, but we want to just work the whole time, and then after work, we want to relax. And that we justify by making lots of excuses, lots of justifications we make. But we never understand the importance of that. If we discipline our life in such a way that 30-40 minutes of revision, we cannot take a time out of our busy life. We don't deserve to pass the course because we do not devote our time, ourselves to study it. See on the screen within the live course, jumping back to last week explanation and today's, I'm doing my still best to connect. But that's my thing. Imagine if you at your side are also revised with, then you'll be able to see the way that I'm moving on into one slide and going down to that slide. You're comfortable on that. And if you have not revised, you'll be confused what's going on. Sometimes the lecturer is on this slide. Sometimes he takes me back to that slide. So I'm confused. Because you will remain confused. You do not want to listen to all the instructions that everything I demand from you, every time I give it to you, and ultimately you feel bad about what's going on. So much confusion. Sometimes I go back to that case. Sometimes I come back to this case and I'm confused. Then realize your mistake, why you're confused. Because you're not studying. You're not revising. You cannot just give 30 minutes out of the whole 6 days. Since the time the last lecture was taken, you could not just manage to give 30 minutes. Do you deserve to qualify even ACCA one day? Be honest to yourself. How much similar this case, the one that we are discussing, is to the one we have done the last week? Overall theme remains to be the same, except the flow of transfer is to or from. In that case, it was being by NCI towards group. In the case of today, It's the group who makes the transfer towards NCI. One day you have shared your meal to someone, the next day someone will share their meal to you. But overall, what is happening? Meal sharing. Today we are selling part of our interest to someone, so we will rather be compensated, we will get a money. But the other day, we rather had been acquiring the subsidiary in parts, so we had been paying the price. These things cannot be crammed. These things can always be remembered by having a sense of what's going on. And that is where you will become successful, when you will understand by yourself what's going on in this topic, rather just waiting for me to explain everything and just wanting to cram a pro forma and then act upon. See, this transfer to NCI, this word "to" is so much important that you cannot cram. If you have got this whole picture in your mind, then you will be like, okay, it's the transfer. This time the group is making towards NCI. So you will not need to really be so much worried of that the word "to" I have to use, the word "from" I have to use, because you actually know what's going on. Group is selling the part of its interest. That means the group will pass on whatever the group has towards NCI, towards NCI, towards NCI. Whereas in the topic we have done the last week, there it was the group who was claiming by acquiring extra interest. So the word "from" was used, transfer from NCI, transfer from NCI. This bit of a difference. And that can create a lot of confusion if you will not respect this topic. You'll end up using the word "to" instead of "from." You will end up using the word "received" instead of "paid." Ultimately, the figure, whatever you will work, will go wrong. Can you see the difference of today's explanation to the one we have done the last week? Few words have been switched. The word "paid," the word "received." The word "to" the word "from." This arrow thing that I'm trying to draw today has changed the direction of that. Overall theme remains to be the same. So how can your life be so much easiest when you pay respect to the one side of the topic and you're actually completing the other side quite automatically? This is what some of you in the course right now will understand, and some of you, I will bet, they will not even understand. They will not still study for the next time the next course will start. They will not. But this has been the case in the past. I'm telling you all of my experience. The complex aspects have started. I've done my job to revise all the basics, so that later you won't complain you do not know how to compute goodwill, NC, and that stuff. I already have prepared you for that in the first two courses of SBR. The steps of consolidation, all that stuff, fair value adjustment, unless profit, those basic aspects, I have done my job to explain. You cannot complain me at later stage that I cannot recall it from the level 2 course, since that was qualified 2 years ago. Since the day we have started complex aspect, undoubtedly, that knowledge is helping us out. You have to admit the first two courses of explanation are continuously helping us out in moving forward. So this adjustment looks to me the same as above. Just the flow has changed. This time it's me as a group owner selling the part of my interest. So I will surrender what I have, equity I have. So I will surrender part of an equity towards NCI. So to reflect that transfer, one has to recognize an adjustment directly into equity. So it's called as equity adjustment. Very simple pro forma. A receipt of consideration, which is an inflow, transfer to NCI, which is an outflow. ultimately will end up getting a positive answer or a negative, will directly go to hit the equity balance. Now we can do one question to quantify all of that stuff. So that is this case. Still, I have been able to spend adequate amount of time in explaining, although it was quite much of a revision-based case. Let's go and take a quick recap in a one go, and we can do one question afterwards. Regardless of the fact we own the company by 90 or 70, as long as we own, have to consolidate normally. Same is applicable to profit and loss. Goodwill was once worked when this company was acquired for the first time at 90%. Later will not remeasure. NCI, we have to make sure we recognize at the reporting day standing, which is after 30% now. There, if the disposal transaction takes place midway, then I already have told you what needs to be done before after picture. Best demonstration. Clearly, you can see in the picture before, 10% for 8 odd months. In the picture after, 30% for the remaining 4 months. You clearly have seen it. The highlight of this case is that equity adjustment. Why to recognize? How to? That is the whole page of explanation. Why to recognize? Group holds the 90% equity, transfers 20% of an equity towards NCI. So to reflect this, the adjustment needs to be passed into equity directly. How to? A receipt of consideration offsets it against the transfer towards NCI. And this is going to be a working, and I can take one question to formally quantify. That is this case. So these points are not meant to be crammed. These points are meant to be understood with proper reasoning behind why do this and why not do this. After this bit of a talk, let's go and take the first question to really apply this knowledge act. I will have to search. Yeah, this one. Illustrative example 2.2. Explain with suitable calculations how the LUP should account for the disposal of shareholding in RAT. So on 1st of January 2009, LUP acquired 90% of RAT for $450 million. The fair value of the identifiable net assets at that point of mark was 380. The fair value of the NCI was this much. The group has a policy of recognizing the NCI at fair value. A year after, they have disposed 10% of an equity for 55, so it reduces its interest down to 80%. R has made the profit and grown by 20 over the year, and therefore the carrying amount of the RAT is this much. So this question, I've picked it exactly from the case we have learned. So the year starts off with 1st of January 2009, ends on 31st of December 2009. %, and 80%. It was a subsidiary remained to be a subsidiary because of that. 90% is what they had been holding. And after disposing, a part of an interest gets down to 80%. That day standing, the goodwill must have been worked. So on 1st of Jan, L acquired 90% of interest for 450. The fair value of NC is given as 45. And the value of net asset is 380. So this is the way that goodwill we always have worked since the childhood, while you were a child at learning the consolidation. And the goodwill, the way we always have worked is that way. And in fact, this has been the reason why these things have been nicely revised in the first two courses of SBR. And today we are playing with these figures, with these workings once again, because these are the working notes which the effects of step acquisitions and disposals, they're supposed to come in. And if you do not know these original workings in the first place, you are at no way to apply those adjustments. And even within that, many of the places, they suggest that, okay, you do not need to have any change coming in. Like goodwill originally calculated remains unchanged. Don't you think that you need to be aware of how the way the goodwill is originally calculated? What if there is a change to come in? Then that should be another thing. But working the goodwill originally in the first place is a prime thing. How can you bypass it? You cannot. Especially after the first two courses of SBR I have run in explaining, in revising it all. How can you bypass this original working of goodwill that might be taking any sort of change in, which luckily in this case, we are not going to have any change in that even. But this is that computation you cannot compromise at. You cannot bypass it. Original working. Regardless of the fact they dispose the part of an interest, goodwill will remain unaltered or unchanged. Yeah, this is the only thing that impacts the goodwill value, which right now will not even, since there is no impairment going on. So what was the goodwill being worked on this day remains to be the same on this date. Full and final. Next, NCR. Starts off with the fair value of NCR, which is 45. NCR share of subsidiaries retained earnings. We will have to see the original percentage of NCR. Original. This has been the original interest. If this disposal was not taken, the company was holding, the P was holding this company by 90, so NCR must have been held by 10%. So when this company was acquired, they have this much of net assets. Which by the time the year ends, which in fact is the day they have disposed the part of an interest, the value of the company has turned out to be 400. 380, 400. 380, 400. 20 is what they have made since then, which is what we call it as post-acquisition profit. So this has been the original amount of NCI that if the disposal transaction had not taken place, I would have come to record the same into statement of financial position of the group. But because there has been a disposal, part disposal, so this will not be the final figure, but this is the figure to get, this is the figure on the way to get a final one. This is the original balance of NCI. And once again, I can come to emphasize on that. How can you expect to not to know this, how to calculate the original NCI? How can you expect to compromise onto it? This is the original NCI without considering the disposal aspects. Now this figure will be affected by the disposal of subsidiary. So what will that be effect? We will understand, we will revise. But you cannot just leave this original value on the way and expecting to learn that effect only. How can you? Cannot bypass it. Needs to be so good onto that in the first place. And for the reason why I was so much concerned in revising the basics. Now you today get to know why. Entry point is the original values. You have to enter into consolidation by knowing the original workings of these notes before you can expect to top them up with the effects of stiff accusations or disposals. These are going to be the top up effects. You cannot compromise on the way onto the basic workings of NCI, goodwill, net assets note, reserves, and for etc. Yes, there we will come to make an effect into it. Transfer from the group. This needs to be worked. Now I can come to explain it, that equity adjustment. So before disposing a 10% interest, this has been the case originally. And it has turned out to be this. So what actually is happening? It's the group who will surrender part of its interest towards NCI. That part is 10%. So as far as the NCI's perspective is concerned, it's the transfer from group. I'm assuming myself as NCI right now, non-controlling interest owner. So I will rather receive the transfer from group, will not go to transfer anything towards group. Being an NCI, I will be receiving. So it's transfer from group. Because of the transfer of equity, adjustment is required, which is called as equity adjustment. So at December 9, L disposes 10% of an equity for R for 55. Transfer to NCI. Now, how to find that transfer? Being the group owner, I have to transfer 10% towards NCI. So to which figure I should make a 10% of? So being the group owner owns the net assets of the subsidiary. So I will have to take a percentage of net assets. If you look on the day the disposal transaction takes place is in fact the date of reporting. Standing on to that date, the value of the net assets are 400. Also, these net assets are originally without the goodwill of subsidiary, which is what we have worked up there to top up in. So yes, when the group will come to transfer, the group will make a transfer of two things: the value of net assets without goodwill, and the goodwill will be topped up in. So effectively, it's going to be 5 and 5. The 10% of that will be 51.5. 3.5. This might be a positive effect onto equity or negative. We will have to see. That's consideration received. That's unfair. Looks to me that they have made a gain out of it since they have received more and surrendered less, which I also can quantify by passing a double entry. A debit of bank by the receipt of 55, a credit of NCI by 51.5, and a credit of, see, automatically the credit has fallen onto which side? 3.5 on the side of credit will go to recognize directly into equity. A receipt of bank is the debit of bank. This has been transferred towards NCI, and what has been transferred to NCI will be a credit to NCI. Well, the balancing figure automatically falls onto a credit side, which was expecting to be an addition to equity. It was also been sensed while comparing the figures, since that was being received and this was being transferred. So 3.5 was supposed to add into other components of equity, and that 51.5, the credit to NCI, let's go to credit the NCI by that 51.5. See, this is the effect of step acquisitions or disposals. This one step, while this one is the original NCI that you cannot expect not to be aware of how to compute the original NCI. Within that figure, the adjustment might add, the adjustment might subtract is just the one little adjustment to it. That in the first place, you cannot expect not to be good at. The same computation can be shown as I have worked down below, being the part of this working note. So this is the balance that's getting into statement of financial position. Originally, this figure was 10%. And I have been able to top this up in by the extra 10% effect. So what's getting into a statement now? 20%. And that is a proof of this statement that NCI, you have to make sure when you will recognize, it has to be based on to the percentage at the year end after part disposal. So what is after part disposal we see in it? This is what we see after. And that is what we have made sure when it will be recognized onto the face of the statement of financial position, it should be for 20%. And there was a way to do it. Not directly, it was worked at 20%. It was originally worked and then later been topped up by that effect of transfer, so that now collectively it is a 20% figure, which is the NCI standing at the year end after disposal. Can you see it? So much of time I'm investing in considering the toughness of topic, considering the newness of topic, complexity of the topic. After you just do not revise and make the mess of that's totally on you then. It's been an hour, the course has started, and we are still on to the same case. And knowing the fact that this case is quite a bit of a revision of what we have done in the last week on stiff acquisition. I should have got through this in 30, 40 minutes, but I'm still about 1 hour. We are into this and not finished yet. Looking down into the solution, first, they work the goodwill, as we even have. Then they have worked the equity adjustment, as we even have worked, a receipt of consideration, and the transfer to NCI of two things, net assets and goodwill, respectively. That's the double entry that I even have been able to pass. Anything so different over here that is making the life of ours difficult. That's the pro forma up there for equity adjustment. Starts off with the receipt of consideration, transfer to NCI, the value of net assets, and the goodwill. Okay with that? Learn example 2.1. At the start of the year, Basta acquired 90% of Rhymes for 44. The fair value of the identifiable net assets of Rhymes on that day was 180. The fair value of the NCA was 40. Calculate the gain arising on the disposal on the acquisition. Fine. At the year end, Basta disposed 15% of an equity interest of Rhyme for 90 million and reduced its interest by 75%. Rhyme has made the profit of 40 over the year, and therefore the carrying amount of the identifiable net asset is 220. This question is just the replica of what we have done, and I can just work the whole of that solution out quickly to end up this whole talk. Year start and year end. At the start of the year, they have been holding this company by 90%, by 70%. Was a subsidiary. $440. The value of NCA is 40. And this is 180. And that is a goodwill being worked at the time when this company was acquired, and with no impairment as such. The same answer we will be able to find okay with that. So goodwill was originally worked, remains unchanged. There comes the NCI. Starts off with the fair value. Tops it up by the effect of the NCI share of subsidiaries retained earnings. The fair value of NCI is given as 40. The original percentage of interest for the NCI is 10%. This has been the balance of net assets the time the company was acquired, which now has turned out to be 220. So what they have made since then is 40. So this is the original balance of NCI, 40 plus 4. Transfer from group. So before 15% disposal, after 15% disposal, the group surrenders part of its equity towards NCI. And to reflect that, one has to recognize that adjustment, which is called as equity adjustment. Fair value of the consideration received and transfer towards NCI. The receipt of consideration is given in the next paragraph, which is about 90 million. Transfer to NCI. Two things will be transferred. It's going to be 15% of the value of the net assets. The value of the net assets okay, so the value of net assets standing it onto that day is 220. In the goodwill, we have worked 300. So it's 520. The 15% of that is 78. Turns out to be 12. Will that be in addition to equity or deduction? Once again, will be in addition, because this is the amount that they have received and that's what they have just passed on. They're kind of making a gain out of it. 78 is what I will be able to top it up in to find me the final answer, which is 122. That's at 10, added the 15 in, turns out to be 25%. That. A total recap of what we have done by spending a lot time onto it. This pretty much ends up the first case, a case which was the different one from the others. And I was wanting to spend time onto that first, and we did. 1 hour, not less than 1 hour. And you people have to admit, whatever we have done is the same, 90% plus same to what we have done last week on the similar case of stiff acquisition. People definitely have seen me working onto this equity adjustment, transfer, picture before, after. People definitely have seen me this prorating the profits in two parts, in the picture before and in the picture after. Consolidation has to happen normally. Goodwill remains unaltered. This has been the whole talk of the last week also. Just where exactly the difference lies, one has to respect that the difference lies over here. That transfer, in that case, the group makes it to NCI. In that case, it's the NCI that makes the transfer towards the group. This allows us to go and take ourselves down to the cases where there's going to be a loss of control. And for this, the first one we will take is the full disposal. These discussions coming to your way are going to be different ones. But rest assured, what we will do in this case will help us in applying the same knowledge to these two. So learn this one nicely. These two will become very easy. Because overall theme will remain to be the same because of loss of control. So let's start ourselves with the full disposal. Once again, making a nice title of the topic on the top of this page and the case that we have chosen. An example down below that instantly gives us the knowledge of, okay, what this case is about. 80% held and they disposed the entire 80% of an interest. What will be the effect of that on consolidation? Now, full disposal leads to lose a control over, and that will make us to say what? No to consolidation. It's pretty obvious. No consolidation. Simply because of the reason of loss of control. Because of the reason of the loss of control. Because of the reason of the loss of control. What if it is a mid-year disposal? Then profit and loss can still be consolidated till that point. You know that these two statements are slightly different. For statement of financial position, we cannot consolidate it for part of a year, but profit and loss can still be. Say if the disposal transaction has taken place in the 10th month of the year, then for 10 odd months, we still will consolidate. So consolidate till the date of disposal. And you know how to do that. 10 by 12 multiplied by revenue figure. 10 by 12 multiplied by cost of sale, finance cost, taxation cost, admin cost. Just the way the mid-year acquisition is treated the same way, the mid-year disposal will even be. So statement of financial position is a clear no, because you cannot prorate the assets and the liabilities. We rather come to look onto the day the year ends, a reporting date, which definitely suggests no longer control and makes us to say no consolidation. But profit and loss can still be for some months, provided if it is a mid-year disposal, then till the time they're still controlling, they will consolidate. The highlight of this case, if you will ask me, is going to be this thing. A gain or maybe a loss on the disposal of subsidiary will be calculated and recognized. And ask me why. Because there is a disposal going on. So don't you work the gain loss onto disposal while you even dispose a single plant, motor car, building, or any asset, you name it, don't you? So why not for this now? Subsidiary is an investment of the parent. So the parent today has disposed. So just the way on any random disposal of asset, we come to the gain loss, we will even be on the disposal of subsidiary. How to is another talk. It's a pro forma of computation. I can take you to words, but why to, I guess, is pretty much digestible for all. Why? Because you dispose of an asset just the way you work the gain loss onto a disposal of any random asset, you will still be working the gain loss onto a disposal of subsidiary, which is an investment of the parent. Subsidiary is gone, needs to be derecognized. So upon the derecognition of the subsidiary, one must have to definitely work the gain or maybe a loss, which will be a working we will do once, and both the figures or both the statements will take the same figure. A gain and loss on the disposal will be recognized. Why to? I have explained. How to? That I can finally reveal. This is the pro forma of computation. A gain or maybe a loss on a disposal of subsidiary. It definitely will start off by taking the balance of consideration, receipt of consideration, fair value of the consideration received. A consideration is the balance the question will provide to all of us. It will be provided. It will be provided. Fair value of the consideration received. In the inner column, we will have to work the value of the subsidiary by taking these steps: net assets, goodwill, NCI. All of these three figures, they will have to be used in the inner column, because the idea is to find the one figure out of it, which will then be matched up with the proceeds to get this one. We are trying to find the value of the company, value of the subsidiary, by taking all of the net assets, goodwill, minusing the NCI from. You see, the first two of those balances are debit. NCI is a credit balance. So make sure that when you write the NCI in this, you must need to deduct. Cannot be adding, definitely need to. See, when we have consolidated a subsidiary, we have consolidated the net assets of subsidiary by combining. There we had been recognizing. Goodwill was recognized. NCI was recognized. Today we are just making a U-turn, coming to derecognize. Derecognition in simple word means removing. Subsidiary was recognized. Today we are removing all the components of subsidiary in the shape of net assets, goodwill, NCI. So one of the value needs to be found out of it, which will then be compared with that to get this. Net assets plus goodwill minus the NCI will give us the carrying amount of the subsidiary, which will then be compared with the proceeds to get this. So these working notes, we know in the background how to find the goodwill, we know how to find the NCI, we know the value of net assets from the note of net assets. We just need to plug in those figures into this inner column to get this one figure out, which then will be compared with the proceed to get this. So the contents of this pro forma are not new. You know how to find them respectively. As long as you've got the figures of NCI with you, goodwill with you, net assets with you, you're just going to plug in them into this pro forma to arrive at your answer. That pro forma will become so easy, because the body of this pro forma has all what you know how to calculate. Just the body needs to be remembered. Okay, that starts off with consideration, and then that takes inner column working to arrive at my final answer. So you just need to be aware of the sequence, that what will be the sequence to start, what thing to write first, second, and third, and on. But whatever is within the body of this pro forma, the contents I'm talking about are the ones we know how to find them. Just need to plug in those figures respectively to arrive our answers. Could be a gain, could be a loss. The profit and loss will take. The discussion we are having it now is applicable to group financial statements. We even can be asked to find that gain and loss into the individual financial statements of subsidiary, a parent. which is going to be like an everyday computation. Fair value of the consideration received minus the carrying amount of interest disposed. This is not the main working. The main working is this one. But we can still be asked to compute this. So I'm explaining. And this is like an everyday task. Think of, you dispose of a plant. What do? Proceeds minus the carrying amount of plant, don't you? That is happening over here. Proceeds minus the carrying amount. This is like an everyday sort of computation, which you can also be asked. So I'm preparing you for that. But this is the main one which you need to learn and more testable. Two separate figures will be worked. This will go in group financial statements. This will become the part of individual financial statements of parent. You will have to see which one the question has asked us to find so that you can apply respective pro forma. That is the end of this case as far as the discussion is concerned. We can just apply that into one of our question to quantify. This case does not offer anything except because of the loss of control, you have to say no to consolidation. It removes every burden because once you have said no to consolidation, then we obviously will not be worried for how to recognize this, what to recognize, where and all, because we had just said no to consolidation. Yeah, profit and loss can still be consolidated if it is a mid-year disposal. Till that point, they're still controlling, say for 5 months, 8 months, 7 months, they will be able to consolidate till then. Gain and loss, one has to calculate and recognize. How to? The pro forma of that is pretty much easier. Starts off with proceeds, pretty obvious. You have to make sure you compare the proceeds with the carrying amount of subsidiary. The carrying amount of the subsidiary will take 3 components: net assets plus goodwill minus NCI. And if they have asked us to compute a gain or maybe a loss in the individual financial statements of parent, it will simply take the proceeds minus the carrying amount of an interest disposed. Let's take this question. To finish it, illustrative example 2.1. So G purchased 80% of the shares of B 3 years ago for $60 million and elected to measure the investment at cost in a separate financial statements. The fair value of net assets at that day was 65. The fair value of NCI was this much. G values the NCI at fair value. At June 30th, 2009, G disposed of an entire interest in B for 85 when the net assets were 70. And there had not been any impairment of goodwill since the date of acquisition. So exactly the case we have been tested on. This company was being held by 80%, I guess. Yeah, and they have disposed the entire interest. This is called as full disposal. It was a subsidiary, but definitely will not going to be a subsidiary over here. And there has to be a loss of control. Which day they have disposed? June 30th, I also can mark. This is the day standing it on. We will have to work this pro forma. And we can save a bit of a time on it by copying and pasting that pro forma. Okay. So on June 30th, G disposed of an entire interest of 85. So 85 has been the balance of consideration. That day standing, they suggest the value of the net assets was 70. Well, these two are going to be our workings, and we can happily work the goodwill and NCI as ever we have worked. Starts off with cost of investment, NCI, and the fair value of the net assets. So goodwill has been worked by using that 60. Value of NCI on that day standing was given 15. And the fair value of the net assets was 65. This is goodwill. Yes, the goodwill, because since that day has not been impaired, so standing today, the carrying amount of the goodwill must have been the same in the book. So I will use this for the purpose of derecognizing. But imagine if the goodwill has been impaired. Imagine if it was impaired by 8 by now, then I must have used 8 over here to derecognize, because which day standing it on, the company is disposed June 30th. So we have to see the value of goodwill of that day. So if by that time the goodwill has been impaired to 7, we must use that 7 to derecognize the goodwill act. But unfortunately, or fortunately, the goodwill has never been impaired. What was being worked originally must have been the book value today. So I must pick this up and punch this into this pro forma to derecognize. The fair value of NCI is 15. And this is what I was talking about, that the contents of this pro forma are in fact the items. We know how to find them. We just need to find them and plug in. NCI share of subsidiaries retained earnings. What is the NCI share? It must have been by 20%. This has been the value of net assets the time the company was acquired, which now has become 70. So what they have made since then is 5. This is the value of NCI in the books, that if I was not disposing a company, I would have recorded the NCI in the consolidated accounts by 16. But today the idea is not to record. Today the idea is to rather remove. So for the purpose of removal, I will come down to record this into a pro forma and should need to deduct. Don't forget, NCI is a credit balance, which definitely needs to offset with the rest. That should be the answer of it. 85 minus 64 should be the answer to it. And that should be a gain on disposal. How simple that pro forma even looks when you have been given a way and you follow that way in your revisions and try to remember it. But this is the only one thing in this. This is the gain on disposal we have worked, the one that will become a part of group financial statements. Now, if the question requires us to find the gain loss onto a disposal in the individual accounts, the situation will be slightly different. And that will be worked this way. Gain on loss on disposal in the parent's individual financial statements. What is the name of a parent right now? Gores. And the pro forma of the computation is the consideration that has been received is 85. while the carrying amount of an interest. This company was acquired back in 3 years ago for $60. Same must have been the book value of it when I will be able to compare it, because investments don't depreciate. So what is the cost in the past that they have incurred in acquiring must have been the book value of that investment today. That is the gain will become a part of the individual financial statements of the parent. Individual financial statements of the parent. Okay with that? So same way the NCA has been worked, same way the goodwill has been worked. And we just have been able to punch them into this pro forma, which pro forma of the computation is slightly a newish thing. So you just need to understand the composition of this pro forma, what it takes first. It starts off by writing the balance of consideration. And then 3 items, I must have to write them into inner column, starting off with the net assets, the goodwill and NCI. Okay, good with this, no problem. If you look into the solution, they even have worked the answer the same way. They start off with Gore's separate financial statements in the first place, and they've got the same figure. This one is getting into consolidated accounts, and they've got the same answer, and exactly the way that we even have got, they even have. So much easily readable and explained. Pretty much ends up this case. No further thing to look in. Gain on the disposal in the parent's accounts. See that 2-line pro forma? And the gain that goes into group accounts, that pro forma of taking the consideration and this inner column carrying amount working to get this. So if parent sells its entire interest in subsidiary, then it will cease to consolidate that subsidiary from the date the control is lost, and will recognize the gain and loss in the group accounts. The parent will also recognize the gain and loss in the individual accounts. See, this is how the way the text is written back into your lecture notes. Not as lengthy as you may have imagined, followed by these pro forma of computations and these applications to end up this case. And this is what I try to make it more easier for you by making these sorts of bullet points. With proper reasoning, with proper logics, I explain to all of you each of the point. Pretty much ends off the talk of this first case of losing the control. Okay with that? See, there we're not discussing anything like that. NCI you have to recognize at this value. Goodwill you have to recognize at this value. Because we're not going to recognize all of that. We just simply have said no to consolidation. So it becomes meaningless for us to be concerned about at what value the NCA has to be recognized. Because we're not recognizing that. At what value the goodwill will be recognizing. In the first place, when we have said because of a loss of control, you have to say no to consolidation, that just shuts the door of every discussion. Yes, importantly, because the subsidiary is disposed, so one has to de-recognize it. And upon that de-recognition, a gain or maybe a loss computation will come to our way. And that way is this way. That's it. Both for the individual accounts and for the group accounts, you should be ready to work, as I even have done in this question. This is the main computation, which is more testable, but you can even be asked to work this. So prepare yourself with that even, which is like an everyday computation. Comparing the proceeds with its carrying amount is like an everyday sort of computation. This computation is the consolidation one because it takes goodwill, NCI, net assets. So work the goodwill as the way you work normally. Work the NCI as you work normally, and then fix them into this pro forma to arrive your answers at your answers. Pretty much ends off with another case of disposals. Let's take a break for 10 minutes. Once I will get back and resume the course, we will head towards to these two cases to talk about. So stay tuned. Do not go anywhere. I will see you in about 10 minutes to continue the course. Okay, I'm back. Hope you can also be with me in the continuation of the course of today. Let's straight away get into our next case so that we can finish this off today. Okay, subsidiary to an associate after disposing apart. A title of the topic on the top, the title of the case we are choosing. 70% it was held, and by disposing apart, turns out to be an associate, and the control that they had it once gone. So that will make me to say in the very first place no to consolidation because of the same odd reason. Remember that reason, and I can still share that reason. No consolidation for the same reason of because of the loss of control. Because of the loss of control. Because of the loss of control. I guess that does not require to have any further debate. Why not to consolidate? You people are continuing this topic with me from the previous, or I would say recent case that we have done. Same theme you have to keep into your mind. Why do we have to not to consolidate? Because of the loss of control. Fine. And you know that this profit and loss is a statement where we still have to consolidate, but then we do it till the time we are controlling. So consolidate till the date of disposal. Till the date of disposal. And you know what does that mean? If P has disposed the subsidiary somewhere during the year, 3 months after, then for the first 3 months, we will still consolidate. Because of the loss of control, because of the subsidiary is disposed, it's gone. So one has to recognize the gain or maybe a loss on the disposal of subsidiary. That explanation is even going to be the same as above. Anything new so far? Anything new for you have noticed? I bet you have not. And you're not even feeling something is different so far because it's the same talk going on. Because of a loss of control, because of the subsidiary is disposed, so one has to calculate a gain or maybe a loss on the disposal of subsidiary and recognize. Performer of computing the same, computing the gain and loss will pretty much be the same with one difference you will highlight. Let me go to reveal the performer of computation. Isn't it the same performer as before? Starting off with the consideration received, deducting the effects of net assets, goodwill, NCI. But you probably have noticed the one new thing, and that new thing is this step, inserted in. And you can understand that why now? Because the previous case was the case of full disposal. In this case, part disposal. So after disposing a part, they're still retaining some. That part that they're retaining, in fact, is an associate. And this is the fair value of that associate. The fair value of an interest retained is bound to be applied to this case because they're not disposing the entire interest. They have disposed a part of the subsidiary. With that part that they have disposed, they have lost the control. But still, they are keeping something with them after. What they have kept after is associate, and this in fact is the fair value of that. This in fact is the fair value of it. And the question will provide this to us. We just need to punch the figure of it. So that by how far this performer is different from the above we have done. Means the difference of full disposal to part disposal is only this one extra figure. which obviously in the full disposal, you cannot think of inserting, since after full disposal, you are not keeping any part. But after a part being disposed, this step is bound to be applied. It's obvious to apply, it's definite to apply, that you can never be confused about. The rest remains to be the same. Consideration received, and then inner column with those 3 points, net assets, goodwill, NCI. We will work them up, we will fix them in to find that one figure, which will be then compared with the proceeds to get the answer of a gain or maybe a loss. And the second performer of computation, that is for the individual accounts of parent, and that even goes the same way as above, for comparing the proceeds to its carrying amount to get that answer. So without even I have to say it, you also at your side feel it, that what's so new in this case? Even as a student, you start feeling it. There's nothing new going on. It's just the same way as above. Yeah, I can see a difference was there, which I had not recognized in my previous case because it was a full disposal. But now when you have opted for the case in which there is a part disposal, so this step is bound to be applied, since after disposing a part, you must have been retaining some interest. So that should be the fair value of it. And question will provide, we don't have to find. Taking you back to the pages of explanation. After losing the control and saying no to consolidation, and based onto that, working the gain and loss onto a disposal of subsidiary, what are we left out with? Associate. That rather will be recognized. That is the third point to end my talk. Associate is recognized under the equity method of IS 28. It's your job now to remember this method, since I have explained it to you this in the second course of SBR, equity method of IS 28. I just have to make a reference today. Look, associate, you have to recognize. Under this method of this standard, your mind should start working. Oh, equity method. Let me go and check from the second course of SBR, where the lecturer has given the whole of an insight of this equity method of accounting, that associates are not consolidated because we do not control an associate. Rather, we try to find that one figure. And there was the way to get that one figure. There's the performer of computation to get that one figure done. I, as a student, need to be aware of. And if I'm not, I will struggle. And now you can see why I was so much concerned in revising the associates also, while I was revising the basics of consolidation, because they are becoming a part of this topic, step acquisitions and disposals. So if today I say that the equity method of IS 28, my job is done, because I know I have done my part. I have explained to all of you this equity method of IS 28 in the second course of SBR, and you can't expect me to explain to you this every time then. Once the job has been done, in the second course of SBR, third course of SBR, while I was in the revision phase, I had been able to explain to all of you the way the equity method of accounting works. It's enough for me to say, it's enough for me to give a reference to you to look, work it under the equity method of IS 28. That's it. You know yourself the equity method of accounting. So getting back to the point, no consolidation because of control lost. Because of the loss of control, subsidiary needs to be derecognized. So one has to do this. This was the explanation of the last case also, full disposal. But because it's not full disposal, what are we left out with? We must definitely have to recognize it. So it's obvious for us to even recognize an associate now, since what are we left out with is an associate. That rather will be recognized under the equity method of IS 28. flavors of subsidiary and associates, two in one. As the title even suggests, subsidiary is one thing, associate is another thing. So you must have to have the knowledge of this one in the first place. Can't be casual on that also, and needs to have a knowledge of that also to understand the whole topic. Same, I will say it for profit and loss, that associate is recognized under the equity method of IAS 28 as from the date the disposal of subsidiary may be. The some months of consolidation, some months of associate. Say 4 months of consolidation, 8 months of associate, or vice versa. 8 months of consolidation, 4 months of associate. Or by the way, these months can be any, by the way, just hypothetically I've called. It can be 6 months, it can be 3 9 months, it can be 10 12 months, 10 2 months, some months of consolidation, some months of associate, as long as if it is a mid-year disposal. And like I said, you at your side must have been aware now what is equity method of IAS 28. I'm not going to give you a recap of it. First 2 courses of SBR was in fact the recap of it. You had all of you been there, maybe 1 or 2 they had not been. You had participated in those revision classes. Recordings are made available to you. Whiteboard explanations have been made available to you. So if you're not using them oftenly in your life, what do I have to do with this then? I've given you all of my service. I'm giving it to you by conducting the live sessions. Later, I provide you all of your resources onto the drive. Instantly, I provide. I never have delayed the uploading of recordings and materials. And if you're not using that and you're just piling it up, what can I do more than for you? That if sitting into a course, you cannot recall the equity method, and you have to feel a bit guilty about that. Is this the way you're going to pass the SBR? Not even bother to revise that once, what was being done 3 courses ago, 2 courses ago, and not been able to recall equity method today sitting into SBR and calling yourself to be an advanced level student. Equity method of accounting applies to associate, which requires an associate to recognize it as a one single figure, either into a statement of financial position or into a statement of profit and loss. We just need to work that one figure. And there is the way to find that one figure. That way is in fact the pro forma of computation. Well explained to you. We do not consolidate an associate. We rather find the one figure, both for statement of profit and loss and statement of financial position under the equity method of IAS 28. You should know how to find that one figure for the purpose of recording an associate. The background working of that one figure is in fact the pro forma of computation. Being a part of the topic of today, I just have to say to you, look, no consolidation, but yes, have to recognize an associate. You know at your side how to record an associate. Not the topic of today, how to record an associate. Gain or maybe a loss onto a disposal of subsidiary, one has to work. Why? Because of loss of control. How? That perform, which is what you people have seen me explaining to you before, with only the one difference that has been embedded in the value of interest retained. Pretty much ends up with this case also. So if I have to take this moment to also jump myself down to the next case, and then we can just do the questions in a one go after, because there's hardly going to be any change in the third case, except wherever the word associate is used, we will go to use the word simple investment. Overall theme will remain to be the same. And you will see. So let me go and land myself onto the discussion of this case so that in a same flow, we can see how much close to each these two cases are. and then we can just focus on 2 questions in a one go after. See, the case starts off by starting off with the title of that page, disposals. The title of the case, subsidiary to simple investment, followed by its example. Pretty much explains to all of us what type of case we are in. And then same talk. Because of the loss of control, we will have simply to say no to consolidation. And third time it's coming to our way. And third time, I'm just repeating because of loss of control. Profit and loss, you know, that is a different statement where we still have to consolidate till the time we are controlling mid-year. Third time, in a space of previous 30 minutes, you people have seen me repeating the same stuff, no consolidation because of loss of control. Profit and loss can still be consolidated, provided if it is a mid-year disposal, that can be 4 months, 5 months, 8 months, 9 months, 10 months. But overall theme is that we have to stop consolidating the moment we lose the control over to S. That is a basic theme. And for the purpose of de-recognizing the subsidiary, this computation will be the part of every case. Compute the gain or maybe a loss onto a disposal of subsidiary. And that pro forma of computation remains to be the same third time around. A carbon copy of what you had just watched 10 minutes ago, a receipt of consideration, a value of interest retained. This time the interest retained is a simple investment, not an associate, but still what we have retained, we must have to have a value of that. That typical inner column working that takes net assets, goodwill, NCI of subsidiary. Any difference? If they ask us to find the gain loss into the individual accounts, third time in a row, we will be able to find that out by using that way of comparing the proceeds to its book value. Any difference? What do I need to explain more in it? Tell me. Itself, you can have that feel that there's nothing new going on. At least once by formality, I have to come down to show to all of you this page to make sure that we have looked upon. Otherwise, this page is just a carbon copy, a duplicate of what you have just watched above. This one. Exactly a duplicate. Yes. What are we left out with? Simple. So we must have to recognize it. But this has to follow IFRS 9, not IAS 28. Simple investment is recognized under IFRS 9. So IFRS 9 is a standard which we will be doing later on, being the part of our financial reporting standard. Since IFRS 9 is not a consolidation topic, it's a financial reporting standard. Financial instruments, we will be doing that in the later part of the course. Today, I just have made the reference that look, simple investment you have to recognize. But according to this respective standard, so this standard is going to be covered later in the courses, which actually is on financial instrument, fair value through profit and loss financial assets, fair value through other comprehensive income financial assets, amortized cost financial assets. You probably have remembered these terms from the basic courses. Simple investment will rather be recognized. Subsidiary will no longer be because of loss of control. Profit and loss is always like some months of consolidation, some months of simple investment. So simple investment is recognized under the IFRS 9 as from the date of disposal of subsidiary due to mid-year acquisition. 6 months of consolidation, 6 months of investment income from that investment. Any difference? Except where the word associate was used, been replaced with simple investment. Associates are accounted for under IAS 28. Simple investments are accounted for under IFRS 9. Otherwise, overall theme, remains to be the same. What is the overall theme? Loss of control. Say no to consolidation. Calculate the gain loss onto a subsidiary. This is the basic theme in all of these cases we have been working since the past 1 hour. Say no to consolidation because of loss of control. De-recognize the subsidiary and work the gain loss. In the full disposal, we stop ourselves over here. But in the case of part disposal, we also look into a situation that's after. In after situation, if you have an associate, do recognize an associate. If in the after situation you have simple investment, do recognize the simple investment. This is the basic theme of the topic that you can keep that out onto your fingertips. No need to cram these points and every time come to read this again and again. The pro forma of computation, try to just learn it once and modify it. This is for full disposal. If I remove this one extra row in it, that pro forma will be the pro forma of full disposal of subsidiary. This one is for part disposal. And after disposing a part, the interest that you have retained might have been an associate or might have been a simple investment, that depends. Nothing otherwise in this pro forma will change. This to compute takes the always the same typical process. Receipt minus the carry amount. Pretty much ends off the talk of the two of those cases of disposals. And now we can take few questions from our lecture notes to complete this side. In fact, I've done one question on disposal. We have yet to practice questions on these two cases, and we are happy to practice, starting off with this example. It's learning example, illustrative example 2.3. 2.3, illustrative. On 1st of Jan 2009, Rock acquired 60% of Star for $360 million. Star has an identifiable net assets with a fair value of 400. The fair value of NCI is 200. R recognizes the NCI at fair value. So typical. And so far, they haven't said anything like disposals and all. But yes, at the time the year ends, they have disposed a part of an interest and loses the control, but retains the influence through its remaining 45% of an ownership. The fair value of an associate retained is 420. Now that's how the way the question will provide us with the values. Fair value of an associate is measured at 420. At the year end, Star had the identifiable net assets of 430 million. Of the increase in the net assets of 30, yeah, we can see an increase of 430 if you can look into that watchfully. 400 going up to 430, the overall increase that we have found in that is $30 million. 28 had been reported through statement of profit and loss. 2 million of that relates to debt instrument, classified as fair value through profit. Oh, we have done this OCI reclassification the last week, so this is getting back to us. I was trying to reclassify the OCI thing to profit and loss on the disposal of investment. So we might be doing the same thing in that. It will be a revision. They want us to calculate the profit on the gain on the disposal of subsidiary, which is the only thing in this question they have asked. So let's get on with. On 1st of Jan 2009, 31st of December 2009, they have acquired the company by 60% and they have just disposed this has been the subsidiary, turns out to be an associate, turns out to be an associate. Subsidiary it was, turns out to be an associate. That is standing we have to compute again on the disposal. And why not? Because this is the day of losing the control. But the gain on disposal we are working over here, the one will go into group financial statements. Starts off with in fact, I can copy and paste that pro forma, or I can write it once again, fair value of consideration received. Fair value of an interest retained. And three things, those are will be recognized: goodwill to start off with, net assets, and NCI. So they have disposed 15% of the staff for $150 million. The value of an interest retained is 420. This is going to be a working, this I guess is given, this is going to be a working. The net assets are given, standing it onto that day of 430. You just need to work the goodwill, and we easily can, like always we have. Starting off with the value of cost of investment. Topping this up with the figure of NCI and subtracting the value of the net assets. So cost of investment are acquired 60% of the staff for 360. The value of NCI on that day was 200. See how smooth the process is if you know everything from the basics to the advanced. Everything by a combined effect will make you complete your answer. Computing the goodwill has been the part of every question. And do not know if we have revised the goodwill for about 30, 40 odd times in the space of past 3-4 sessions. Because every question you attempt, the goodwill has been the part of it. And this makes me to repeat that process every time. That even you have not been revising, or you are not revising, I suppose some of you, you must have got this thing so much understood, since every time you watch me doing it, every time you watch me doing it, every time you watch me doing it. The value of net assets on that day standing was 400. Why are we computing the goodwill? Why are we? Do we have to record? No. We have said no to consolidation. But then why are we computing the goodwill then if we later do not have to recognize it? Because of one reason. And that reason is that because we have to compute the gain or loss onto a disposal of that subsidiary, and the goodwill is going to be the one component of that computation. So we need to have the goodwill with us. So this time the goodwill is not being worked for the reason of recording it onto the face of group financial statements, for the reason of removing it rather. So we need to have the figure with us. And to arrive at that figure, the process remains to be the same as always. Which day standing it on this goodwill was worked? 1st of Jan 2009. 31st of December 2009. This is what I have even told you before. That if the goodwill has been impaired by now, we must have to use that impaired value to de-recognize. But once again, the goodwill has not been impaired from that point of mark to this. So we only have that 160 to take. Intentionally, I'm doing it so that later you do not just end up using the cost. What if this goodwill is impaired by 10? Well, this is the value at which the goodwill in the books being carried at should be used to de-recognize the goodwill at. But because of no impairment, so luckily it was the same as above. So don't be confused by just using the cost every time. If it is impaired, use the impaired value. You see, you dispose of an asset. Don't you compute the gain loss onto a disposal of asset by comparing the proceeds to its book value or cost? Tell me, do you use historic cost? No, you rather use the book value of an asset of today when you have disposed. So book value has to be used, not this, which luckily right now it's the same because of no impairment. So don't just be casual about that. You will end up making a big trouble on it. NCR to find. Let's go to find easily as always. The fair value is given as 200. And I'll be able to top this up with the NCR share of subsidiaries retained earnings. That's going to be 640% of 30. Yeah, we have noticed that 30. So this is the NCI in the books today. And my objective is not to keep it in the books. My objective is to remove it out of books. Use this amount over here for the purpose of computing the gain or maybe the loss. So it's 160 plus 430 minus 212. The figure turns out to be 378. 150 plus 420 minus 378 turns out to be 190. That is again upon which this question or whatever they have asked comes to an end. Now, if they have asked us to compute the gain on a disposal of subsidiary in the individual accounts, which they have not asked, but I still can work for your revision. In the group financial statements, the name of the parent right now is Rock. Fair value of the consideration received less the carrying amount of an interest retained, not retained, interest disposed. So what have they received? At December 9, Rock sells 15% of the staff for 150. And carrying amount of interest disposed, that requires me to look back and see 360 million. This is what they have paid when this company was acquired, 360. So if they have disposed it today, it will be 360. But they have disposed not the entire interest, they have disposed 15%. So if $360 represents 60% of the investment and they've disposed a part of it, that's like mathematics. We will have to work this answer this way, isn't it? Have to work the answer this way. Can't be taking 360. It's not entire disposal. Don't get me wrong, because previously we have used the entire value because of entire disposal. Now we have disposed a part of it. Out of 60%, we have disposed 15. So that is bound to happen. That is the end of it. One thing that needs to be done over and above to this is this IFRS 9 reclassification adjustment, which is not a consolidation thing, but because they have asked, so I can see the carrying amount of they have provided to all of us with the carrying amount of net assets on the date the company was acquired, 1st of Jan 2009. And we are comparing it with the fair value of net assets on 31st of December 2009. So carrying amount of net assets 400. This has gone up to 430. So whatever the change that we have noticed in it is $30 million. And this is what they're telling, that out of this $30 million, out of this $30 million, $28 million has been recorded into profit and loss, while $2 million has been recorded into OCI. Now this needs to be reclassified. This needs to be reclassified. According to IFRS 9, this will be reclassified. Reclassification under IFRS 9. How to? Same way as we did the last week, OCI will be debited, profit and loss will be credited. According to IFRS 9, this needs to be reclassified. This needs to be reclassified. This needs to be reclassified. Any amount that has been recognized previously in other comprehensive income reclassified to profit and loss on the disposal of that investment. And then I also was explaining to all of you that there's a list of items for which we are allowed to, and there is a list of items on which we are not allowed to. On equity investments, valuations, and pensions, it is not allowed, but on debt instruments, cash flow hedges, and foreign exchange differences, it is allowed. Being the part of your lecture notes, I also have highlighted this the last week. I can bring out that page in front for your quick reference. See, this was being done the last week, that on some items it is allowed and on some it is not. Valuations, pensions, and equity investments, not allowed. But in regards to cash flow hedges, foreign exchange differences, and debt instruments, it has to be. And so we have, because right now it's in respect of equity debt instrument, I believe. I hope I have not assumed. It is in respect of equity debt instrument. Let me just double check. Yeah, it's in relation to debt instrument. So it needs to be reclassified. So I have. So this thing, whatever is happening, is not a consolidation topic. It's according to IFRS, that if you have an investment which you have recognized it at fair value through other comprehensive income, the chances are there that any gains previously being recognized in OCI. So today, if you sell out that investment, that gain which was being recognized previously in OCI needs to be reclassified. The way it is to be reclassified is this way. More concentration has to be on this. Gain loss onto a disposal of subsidiary in the individual financial statements of parent goes like this. And in group financial statement, it goes like this. Value of an interest retained, the question will provide. Consideration received, the question will provide. These three figures we can be asked to work, and we know how to find them. Easy job, goodwill, NCN, net assets. Just need to try and arrange them in such manner so that we arrive at this answer. What's getting into profit and loss? 192 and 2. Total, what will go in profit loss will be 194. 192 from there, 2 from here. Profit loss will take 194. That's how the way one has to compute the goodwill, and emphasizing it on an impaired value of the goodwill needs to be used, which right now is the same as cost. And that's how the way, ever since we have started off with this consolidation journey, we've been working the NCI the same way as above. Goodwill same as above. Basic theme is that we do not have to consolidate. We rather have to remove the subsidiary, and to remove it, one has to work this. After situation is that you must have to rather record an associate, that under the equity method of IAS 28. This way, the whole of the case has to be on to your fingertips. Now that's how the way back into lecture notes it's being explained with all that talk, which I have tried to make it more easier for you by making those bullet points. This is that pro forma we've been working on, fair value of the consideration received, fair value of an interest retained, and the three components, those will be derecognized, NCA at disposal, net assets at disposal, the goodwill at disposal. But I have taken an approach which is more pleasing to eyes. Means I have taken all of these things in inner column, which you even can write them in the main column and subtract. But this pro forma looks to me more pleasing to eyes. That writing it down, these three items into inner column and shifting the net effect into outer column to be able to match it with, which they have done that in just one column. It's totally your choice also. If you want to make your life more confusing, difficult, then you can go this way. More systematic way is this. While can you see it in between, they have also recorded one more thing. This is that reclassification according to IFRS 9. You also can write this being the part of this pro forma of computation, or you may work it separately. I prefer to work it separately, not to confuse this pro forma, because this is IFRS 9 adjustment. It may not be there all the times in your question. It may be there. So better not to mix up it with this pro forma. And if the need is there, treat it up separately like this. I have done it over and above 2. I could have just come to top of this $2 million into this pro forma itself by adding a row in it and recorded the 2. This could have taken this amount up to 194. But preferable is to work this out separately and peacefully work onto that reclassification adjustment in separation to this. If you look into the solution, they exactly have done that, 194, because in the end, they also have been able to record that $2 extra reclassification profit in, which I did it separately. The goodwill has been worked ever since, the same way as it has been worked. These figures, exactly, they were able to punch this out the way we have. So reading it out, the solutions, and trying to realize that out, that we have understood every bit of it. Okay with that? Let's do this learning example 2.2 to see which case of the disposals that this application has tested us on. What profit on disposal should be recognized in the statement of profit and loss. So at the start of 2003, Adam acquired 75% of this company. Net assets of that they are given on the date of acquisition. And the fair value of NCI is this. At December 3, Adam sells 25% of interest for $250 million. So 70, they had it, 25% gone, left up with what? 45%. Oh, this is going to be an associate. It was S, it will turn out to be as A. The fair value of an associate retained is measured at 410. At the year end, A had at the identifiable net assets of $330 million. So let's quickly work this application learning example 2.2. Start of the year. So I can start off the year as 1st of January 2003, while the day the year ends is 31st of December 2003. %70 to start with and end with 45%. How come? 70% minus 25. So it was a subsidiary turning out to be an associate. So that day standing, we have to compute the gain on the disposal of subsidiary. And this will go into group financial statements. So we'll go in the group financial statements. In fact, I can copy and paste that reform to save a lot of time. So 460 has been the value of, we have to find that goodwill and all. First of all, Adam sells the 25% of interest for $250 million. The fair value of an interest retained is 410. The value of the net assets on that date were 330. So all of these figures were given to us. We just need to find the values of the goodwill and NCI, and we easily can. So it's a revision of revision. This question makes the whole task more smooth, as what's been the part of that is totally a revision of what we have just spent time on that. Just need to change the figures and plug in the new figures in. $460 has been the cost. The value of net assets were 300. So once again, the goodwill has not been impaired. So the value that I'm going to write it up there for the purpose of derecognition is the same as original. The fair value of an NCI is 200. NCI share has to be 30%. I'll have to take the 30% of what balance? 30% is the NCI. This has been the balance of net assets the time the company was acquired, which, no, sorry, not this. In fact, this, which right now has become 330. So what they have made since then is $30 million. 30 multiplied by 30% turns out to be 9. This is going to become to the 9. For the purpose of derecognition, if I go to write this amount up there, I will end up getting my answer 360 plus 330 minus 209. The figure turns out to be 481. So this is the answer that I have ended up with. The same as above. So easy computation, and plenty odd times in the past 1.5 hours, we have been into the same theme of computing the gain loss onto disposal, and that makes us to prepare the same pro forma again and again and again. Within the live session, you start feeling it like that, oh, it's so much repetiting. When you have this feeling, it means you have understood and you have started gaining a command, comfort, fluency over to it. Although they haven't asked, but if I also have to find this one extra thing on gain loss onto a disposal of subsidiary in the individual accounts of the parent, the name of the parent over here is Adam. 460 is what they have paid. They have disposed 25 out of 75. Yeah. That will make us to find 460 multiplied by 25 divided by 70. That's about 165 or 164. C. 460 divided by 70 multiplied by 25, that's 164. So 164, when I have compared to its 250 answer, the figure turns out to be 86. Okay with that? No problem. Got it right. The question that's coming to our way is slightly a longer one. We will keep it for the next time. It's in fact a question where you will get the chance to apply either of the case of disposal in a question of consolidation. Because so far we have done questions. These questions were focusing on to the specific case and requiring us to answer specific one or two things. But this is a question of consolidation, and you will get the chance to see how the cases of disposals can be used within a question of consolidation, and we solve them up. So obviously it cannot be solved in next 10 to 15 minutes. We will keep it for the next time. But it will be a revision based kind of a question. Provided you know the basics of consolidation, the steps of consolidation and all that we do in consolidation, and you also have got the knowledge of the topic of step disposals and acquisitions. By using that all, you will be able to work this question easily the next time into. As far as the step acquisitions and the disposal are concerned, there's nothing being left that needs to be further worked. Interestingly, this topic also offers one extra thing that we must have to prepare, and that one is the disposals of associates. Same way we've done the disposals of subsidiary, we also have to spend time on learning the disposals of associates. But mind you, it's not the discussion for more than, I would say, 30 minutes. Main is subsidiary. Associates are always attached to it, that having a knowledge of that is always the plus. But not having a knowledge of that can be a problem. And you probably by this time have realized that associates has been the part of a talk where the concentration fully was on consolidation, parent subsidiary. Associate has been the part of it. And if you're not keeping that knowledge of associate, then you will then pay a price. And having a knowledge of associate is never a trouble, because it's like a small thing. Equity method of IS 28 requires us to work the one figure for associate, one figure for statement of profit and loss, the one figure for statement of financial position. And you should know how to find that one figure. Explained it to you in the third course of SBR. The whiteboard explanations, you have it for you to access alongside with the recordings. Even if you look into your lecture notes, I have been able to thoroughly look into those lecture notes the time. As you can see, many of those pages of your lecture notes have been annotated, underlined, encircled, highlighted, suggested that we have had a good look onto almost every page of the chapter 2. That was a step acquisition. We have done it the last week, 3 cases, and all of those questions have been labeled and noted, underlined, suggested that alongside where we are focusing on our whiteboard explanations and my handwritten summary notes, we had been paying attention to the way the things are written back into our lecture notes also. What you have to see in that hardly on 2 pages, this discussion has been done. Hardly on 2 pages. Suppose if this chapter has 20 odd pages, 2 pages are belonging to associates. Rest of those 18 odd pages are belonging to subsidiary. Let me show you. See, this is the place the disposal of associates is starting from. And that is the page it ends on. It's not even 2 pages. It starts almost on the half of this page and ends on the half of the second page. That even shows to all of us what? That associate is nothing. It's parent subsidiary show. Associate just forms a little part of that. And having a knowledge of that is always a plus. And in case not having a knowledge of that can be a problem. And see what's being written under the banner of each. Nothing. Some performers. I can see with a little bit of text and performers. And this is what I will also come to explain to all of you in about spending not more than 30 minutes. Each case has been defined the same way as I have defined the parent and subsidiary cases: full disposal, part disposal. Now, for subsidiary, I was using a term control, loss, control, retain. But for associate, that needs to be switched to the word influence, lost. Influence, retain. Associate, it was turning out to be a simple investment. Associate, it was still remains to be an associate, but by less percentage of interest, we will have an influence, which was by more in the picture before. And that is a case of obviously a loss of influence. 40% they had been holding, which in the end, they have disposed the entire. So a little talk under the banner of each, not much to look in. We'll be able to see it, but not spending 30 further minutes. So effectively, 30 minutes, the associates will take the next time, and 30 minutes, this one question will take. So we still expect 1 hour of explanation in the next course on this chapter before this will allow us to step into the third one. The third chapter is on foreign subsidiary. A lot much is expecting to come to your way. A lot much in these 2 courses we even have done. That you can say that by somehow we have finished the step acquisitions and disposals today by spending 2 courses on. And not to forget, before these 2 courses, we have had 2 sessions on the basics of consolidation. 4 sessions. How quickly the time is just flying and passing and we're not realizing. And you will not realize the one day the course will finish. And if you have still not started studying or started to think about studying with the feel that, okay, the course has just started, long way to go, then you will not realize when that time will come, the course will finish and I will say goodbye to all of you. The time will fly like this and you have to be with the time. If you are not still starting to plan to study, you're delaying it. You already have delayed a lot. Many things we have done, and many we will keep on. Every time the Saturday course will come, you will not realize how quickly the next will pass by, and the Saturday course will come. You will see me explaining the chapter 3, chapter 4, chapter 5, chapter 6, 7, 8, 9, 10. It will just go to finish. Once you will lose the whole pace of the batch, you will never be able to catch it up. The best is what? Be with the flow. Whatever in the classes that's been happening, take a time out in the same week to revise it. That's your job is for a time being. Access the board work and revise it. Access the recording and try to catch it up on the part that you have finished or you have not finished, or the part that requires to have a bit of a refresh. So you can open that part of the recording and watch. Have to be with the flow of whatever I'm doing it into classes. Once you're done with this, there are 3 cases of step acquisitions. 4 cases of disposals. It means there are 7 cases. And under the banner of 7 cases, there are a lot of performers, equity adjustments, gain loss onto a disposal of subsidiary. Then some where we are adjusting NCS, some where we are not. In some cases, the goodwill was unaffected. In some cases, the goodwill had taken 2 steps of investment. So there's a lot of things, and you have definitely the chance of mixing them off. As a student, you will mix them off initially. You might be able to apply the points of one case to another, and then you will be able to refine it only then. If you're not going to touch them, you will not be realizing what you're missing it out. And how tough is it? You just feel it like it's easier because it's me doing that all for you. You just sit back and relax and watch it. So you feel it like it's so simple. But as a student, you're learning these things for the first time. For you, it is a challenge. One case you have overcome. Second case you have overcome. If you have revised all 7, the biggest of the challenge then you will face is to remember all the 7 cases in their each place, and you will start mixing them. So first aim is to understand each case in its own capacity. That should be your first aim. Once you're done with all those 7 cases, then you will have to start developing this habit of contrasting, that why this case is different from that one, why in this case the goodwill takes the 2 steps of acquisition, in this the goodwill takes only 1 and the goodwill rather remains unchanged, why in this case we have been working the gain loss onto disposal, why in this case we are working that equity adjustment. But first, you have to be good onto each case in its own capacity. While you work onto one case, forget it about what you have done into that case, this case, and this. Just concentrate onto that one case. Become pro at it. Shift yourself to the next one and become pro at it. Once you're done with all the 7 cases, then try to start talking about and try to contrast it by talking to yourself. That what makes me to calculate the goodwill this time by taking 2 steps. In this, it remains unchanged. There, the NCR was affected. There, the NCR was not affected. This equity adjustment, why has been the part of this case only, not that case? Why in that case, we are working that gain loss onto disposal, which in this case, we have not done. It is a time-taking process. And you have to start investing that time these days, not in the month of November. It will be too late. Month of November definitely is the month of November you have to study, because exams are there in about months or 2 weeks or 3 weeks time. But these 4 or 5 months that you are living in, not the months to enjoy. Have to be with what's happening into classes. I'm warning you, if you are not going to take this along in the month of November, you will never be able to prepare and pass the SBR. Over the life, be with the course, come into course, take a course. Once you're done, take the next 6 days out to get yourself done with. If you have any queries being left into your mind, come to ask me, clarify it. Before the time the next session comes in, revise it a night before, so that you as a student feel comfortable coming into the next course to continue the same topic and feel better about in the live session also. You know what's bad for you and what's not at this point. Point is that we do not come to execute it. We become lazy on that. But I have a job to keep you on reminding. You feel bad about, you good about, but I have a job to wake you up. Since I want you to pass and I have to make you pass this exam, so I will have to keep on saying these things to you over the life of the course. Too tough to handle. Even if I'm in your place, this step acquisition topic and disposals of this, I would have found this topic to be a lot difficult, because there's a lot of confusions because of too many cases. It's not just about steps of consolidation that once or twice I have applied, so I'm okay with. No, there are too many cases, and each case has got variety of bullet points in, performers of computations in. So the biggest worry of my life will be to remember each of the case at its own level and not mixing them off. So by just taking a live course and watching me doing that for you, sufficient is not enough. You have to jump in, revise it, prepare it, and then try to also compare all the 7 in the end to see if you can remember all the 7. At one point, the course of today has come to an end. Like always, we come and we start the course and we finish it off, and the time just passes on too quickly. I already have told you the plan of the next week. When will the course of the next week we will start? We will try to finish it off by spending maximum 1 hour. 30 minutes on that long question, 30 minutes on disposal of associates. We will head towards to the chapter 3rd. I expect all of you to come into the next course by revising all what we have done in the past 2 sessions. By taking a time of the Saturday or maybe tomorrow, you have enough of a time. If so far you have not yet revised, I request you to revise all what we have done to date, the past 4 sessions. I will see you the next Saturday to continue the course. Have a good weekend. Thank you very much.